All right, stocks started off the week with a little bit of a mixed day today. The S&P 500 doing well, of course, with the same reasons as always when it does do well. And then, of course, IWM really struggling today. Kind of a difference from last Friday. Friday was a big change in that where IWM did really well and SPY didn't. But back to the norm, which is what we saw today. And you have the main actors leading the way higher, and the biggest losers are not surprising. Interest rate sensitive areas really got hit today more than normal, of course, with interest rates rising. I'm going to take a look at that. This is kind of a change in where the 10-year note is going. So we're going to talk about that. Big change in where commodities, especially crude oil, is going. Those two kind of go hand in hand at times because of inflation expectations. So we'll talk about how where the charts we're seeing there, the patterns we're seeing there, and how that's impacting risk appetite and how it would be expected to impact risk appetite going forward. Probably not this week, as this week will tend to be a kind of a light volume, very small move week, most likely because of the holiday. But starting next week when we get back from the July 4th weekend, markets will be open on July 5th, the day after July 4th. We won't be here. We won't do a market outlook video that day. I won't be teaching classes that day. We'll be having the long weekend. The markets will be open, but more than likely, more people than just me will be out. So we're more than likely going to have a kind of a light volume week until next week. And so that's kind of why I break down what we're seeing, and how that can impact how we go into next week. And we'll break that down further in the next couple of days. But let's go ahead and get started here with today. Today is Monday, July 1st, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog, come down here and check out some of these other things over here on the right, including our Market Outlook live video. Where I take a look at trades we're still in from old Market Outlook videos, see whether we should stay in them or not. We also put on today's trade already before the market closed there. Come down to the bottom, click this heart. It opens up this tab. It opens up not that tab. It opens up this tab. And click that like button there that pops up right there. Same thing here. Click on this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out, there, to all of our followers on these platforms. So thank you to those who do this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks, and help us get to our 100 likes goal for our Market Outlook tweet. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line still obviously in bullish levels. It was a small range day. After a pretty decently bullish day on Friday, or at least a bigger day on Friday, bigger range, 72 points. We had a lot of volume on Friday. We ended up with only 33 points today, so way back below the average. Market sentiment lines rising is almost back into the upper reversal zone. So it had, was up over here. We had the pullback, brought it down, kept it in bullish territory though. And then now we're turning higher, and we're almost back into the upper reversal zone again. Though the thing that kind of stands out here is this near-term line. It did not get into the reversal zone. We talked about this as our focus of our technical analysis class, how the blue line works, and we talked about how it goes from bearish territory to bullish territory, at least to the upper reversal zone. In a short amount of time, we kind of figured out what that was and how to search for it and all that. That was kind of the point of the class. But it ended up forming a bearish peak, which you see a lot at the end of these bullish moves. Like you see a bearish peak right there. You see a few bearish peaks over here. Though while we're still bullish, before things started to turn down. So here we are again with a bearish peak. Now again, we'll see how far down. Like the momentum line got into the reversal zone, but it's already bounced. The near-term line's not very far. It's in bearish territory, so we'll see how we respond to this pullback of the past couple of days, and where the market goes from here. As you can see, we've been pretty sideways, and we're below the 2.5% mark above the 30-day moving average. So we're really kind of at best converging, right? We're kind of converging here. The Dow Jones doesn't look the same, of course. The intermediate line is not in the reversal zone or even in bullish territory. It is in neutral levels, but it's turning over now and flirting with breaking back down below market sentiment and the chart's midpoint. The near-term line, as you can see, jumped out of bearish territory and didn't even get into bullish levels, right? After a couple of days, it's 3 days now, we're still in neutral levels. It's very flat. You have light pink shading in the yellow line up there, so much different story. And then even the Russell 2000, which had been dark pink shading in the red line, they had a nice strong near-term rally on Friday, really on Thursday and Friday, to get that near-term line up into the upper reversal zone. It obviously has turned back down. Market sentiment, the intermediate line had crossed below market sentiment at the beginning of this run, where we had the dark pink shading and the red line up here. It's still below. It's still in bearish territory. It's still below. So we still are technically in an intermediate decline. We didn't quite get the bear tag, though it's the same idea, right? We just came within inches of closing above the moving average, and then we're back down today, closing below Friday's low point today. So we're still in bearish, still showing a more bearish picture on the Russell, a far less bullish picture on the Dow than what we're seeing on the S&P 500 and especially the NASDAQ, which continues to be really strongly bullish. Intermediate lines up there. Your near-term line did drop down, but the near-term line at least did get above the 80th percentile, where it did not on the S&P 500. Obviously, dark green shading and a green line, and you notice that we are, more than 2.5, we're more than 3.25% above the 30-day moving average. So still very good, strong bullish pattern. That's kind of what's driving a lot of the bullishness here from the NASDAQ 100 into the S&P. And obviously, we don't have that same influence on the Dow, and we especially don't have it very much at all on the Russell 2000. Right now, let's take a look at some of these other charts and start off with our weekly chart. As you can see, we are in the 92nd percentile the past, 3 years? Past 3 years of where we are, how big the gap is between the 10 and 40 week exponential moving averages. We do have a smaller candle, so you can see we're below the moving average here. We've been fluctuated up and down below it multiple times during the last run. We're getting the same thing here. As of right now, it would be a lower Hakinyashi close and definitely a lower high point. Remember, there's 3.5 days of trading this week. With the early day on Friday, and then the full day, on Wednesday, and the full day on Friday. So we'll see how things shake out by the end of the week. But as of right now, again, at best, you get these transitions that can lead to consolidation or this convergence, like we saw here and like we saw here on these pullbacks. And so that's kind of, again, at best, we're in convergence mode here for the major indexes, which are not showing 3 green arrows, but at least you're not showing 3 reds yet on the Russell 2000. That's the one that's been obviously the closest. It's got the red line. The Dow has actually got a yellow line because even though it's turning lower, we're still above it. So we're not quite below that yet, but that's how close we are to getting 3 reds on the Dow Jones Industrial Average as well, after a brief period of 3 green arrows. Just brief, right? And a green line, even briefer with the 3 green arrows and a green line. That made it even briefer there. But you don't have 3 green arrows right now on either the S&P or the NASDAQ because they're MACD, which again shows that convergence mode. When you look at the 2-line version, you see what I'm talking about. We are above the 17-day moving average pretty clearly, but the MACD is not above its moving average. That's convergence, right? That doesn't mean we're going down. That's consolidation, right? Where you do break the 17-day, which is the second number in the MACD, and the MACD is dropping below its moving average. So you have that part, and the histogram is getting bigger to the downside, but we still haven't broken the 17-day moving average yet. And you look at IWM, it is still unable to get above that point of control. So we're very top heavy. The MACD is at negative levels. It's above its moving average, but it's still at negative levels. And your stochastics is actually still in bearish territory despite a recent little run. Today, you can see the price getting slightly but getting back below the 17-day, but also slightly below the 8-day exponential moving average there. If we take a look at some of these other oscillators, we'll start off with the DMI. The S&P still looks pretty bullish, a very low negative directional index. The positive is not quite above 30 yet, but at least it's above 25. So you've had a good trend going there. IWM is a little different story, but the positive is, was above 30 on Friday before coming back down below 30 today. Your negative indicator is below 25. Your ADX is really, really low. So your ADX, in fact, it's been a while since this is the first time all year that your ADX has been below. The last time it was below before that bullish run that started in May, and you can see another instance there in 2021 where things got pretty low, and we had the fake out move, right? The breakout to the upside that didn't hold ended up being a tremendous fake out there. If we take a look at the RSI and the CCI for the S&P, you're still at bullish levels on the S&P 500. On the RSI, the CCI is still working its way down, but again, it's still at bullish levels too. So both of these are still green. Just extend those bars over there. Looking at IWM, or the Russell 2000, back below 50 on the RSI, but in neutral levels, has been between 60 and 40 for quite a while. And then you were slightly above positive 100, but just like that, you're back down, right? So we couldn't get above 150 or 200 to really solidify a bullishness, and we're back down there here today. Let's take a look at the Ichimoku Cloud. Mature bullish trend on the S&P 500, looking good. Same thing with the Qs, very, very mature on the Qs. Your diamonds, not so much. There's no trend, neither bullish nor bearish, and your IWM is the same thing. We've been trying to get to be in the bearish trend or bias to the bearish side, but you are below the cloud. The rate of change is negative. The green line is below the blue line, and we did close back down below the cloud and the green line after trying to get above the cloud and the blue line on Friday. So just like that, we reversed the script there. And then you look at the Bollinger Bands and the Keltner channels, and you can see again the bandwidth is really falling on the S&P pretty sharply. We're not in the upper quartile anymore. The momentum is really dropping down. You got the green dots there. IWM has got a very, very low bandwidth. The bandwidth is new 150-day lows. We're right smack dab in the middle of it, and the momentum was negative, and it's been kind of rolling up. So we are setting ourselves up for a breakout on IWM for a variety of patterns, setting us up for a breakout one way or the other. And again, you can see it would be really bullish if it broke out to the upside, but considering the top-heavy nature of the market and considering that we've had a breakout to the upside, we haven't really followed through on that. It's kind of increasingly likely that breakout might end up being to the downside there. Now let's take a look at the intraday chart here. And you see very sideways move inside day at the bottom end of the range. It's like last week's range was pretty much Friday's range for the most part. Friday pretty much encompassed the whole range. You can see we have quite a few days here inside of this range, and just a little bit lower if you go back to Wednesday the 12th, so almost over 2 weeks ago. It's a very, very small range. The low point is just going to be starting really moving up rapidly. That's why we dropped so much on this range here. The size of the range again, just like we did over here, it drops rapidly when this starts moving up quickly and we don't get new highs. We did get a new high, so the green line did stay above 70, so we made it to 100. Remember, it's got to get below 100 for us to really worry about a change in direction here. Excuse me, it's got to get below 70 before we worry about a change in direction. So because it got to 100, we don't have to worry about that yet. And we are, if you look at where we are relative to the range, we are still in the, way up here, very, very bullish levels. But again, that's going to be changing, right? This is going to start dropping, not because the price is dropping, but because the low is rising. So it'll make the gap small, make the 4-week range smaller. So the same position, the same price will be at a lower percentage of the range as we get smaller. So that's what's going to end up happening here, because we'll ramp up. We've already ramped up to this point. So this is, the 20 days. This is day number 21. So we've already ramped up to here. And we're going to ramp up again tomorrow. We're going to ramp up again on Wednesday. And then for a few days, we're going to ramp up to this low point here, which is almost the midpoint of the current 4-week range. But unless we get significant new highs by Wednesday, the range is going to shrink dramatically here. So that's something to keep an eye on. Diamonds, remember we got the new high over here, but it was a one. As of right now, it's a one touch. Just like that one touch was relatively bullish, this one touch could be relatively bearish. We'll see if that ends up being the case. The range, of course, is dropping pretty rapidly. The low point is going to move up now. The 4-week low is going to really move up here to this low point pretty quick. So, and you can see again what it looks like when you look at it on this chart. You're not in the upper half. You made one little run up there, but it came right back down. You're in bullish territory, but you didn't stay in the upper reversal zone for very long. And then finally, when you look at the range for IWM, you can see we are in the lower half of the chart. We tried to get in the upper half on Friday and even opening up there today before dropping back down again below the point of control. Towards, we don't have a new 4-week low point, so we have we did get a bearish move. We have broken below 70, so we're susceptible for a breakout to the upside. But as of right now, we're still kind of showing a bearish pattern of where we're closing. We tried to get into the upper half of the chart into bullish territory. We failed, and we're back down slightly into bearish territory here. So we'll see how that plays out the rest of this week. I would expect it will probably stay in bearish territory here the rest of this week, as we're probably going to end up with some quiet holiday type trading sessions, obviously combined with summer trading sessions for the rest of the week, which means low volume, small trading ranges. We had a good volume day, good range on Friday. We're back to below average on both these things here today. So when you look at it, 3.36 points is below off the charts here. The volume is back down after ramping up, so we're still right around 0.8%. So when you're this low, the expectation is you're going to jump, and usually when the ranges start to jumping, it's because we're having downside moves, not upside moves. When we've been grinding this much, and volatility is telling us a similar picture. Volatility is back down to almost below 12 again. The VVIX is way below 70. It dropped down big time today, dropping down to 76. And you're almost back to that 85% mark again, which has been acting as the extreme, right? We haven't gotten to below 85% significantly since the end of last year. So since the beginning of the year, 85% has been the new extreme low. When we close below that, especially when you have an extremely low on the VVIX, extreme low on the relative ATR and everything else, it suggests that we're going to pick up some volatility in ranges here going forward, probably after the holidays, so probably after this week. But that there appears to be there's going to be a pickup coming soon in these volatility measures. All right, now let's talk about what's driving this price action. So let's bring us over to our asset class comparison chart here. And you can see the Qs continue to be the biggest performer. But look at this big drop in bonds, especially today. Really over the last couple days, but especially today here. So we'll just look at today. Well, let's go out to like a 5-minute chart. How about we do that? Let's bring this to 5 minutes. There we go. So there's that big drop in bonds. Now you can see a gap down there. If I were to go back out to the Friday as well, you can see bonds also had a big down day on Friday after starting the day higher. And it put some pressure on, like this big drop. It's almost a 4% drop in TLT in 2 days. And now granted, this is not the 10-year yield. This is the 20-year to 30-year as what that looks at. But still, it kind of gives you an idea of where bond yields are going, as we'll see here in a second. Real estate is down. Real estate, again, rising yields will put pressure on this interest rate sensitive sector. Utilities usually gets a lot of pressure on it, as it did all the way up to early this morning, but it rallied kind of in a safe haven mode. Or excuse me, this would be the NASDAQ 100, the Qs. We'll look at utilities here in a second. You'll see what I'm talking about. Also, is a purple color on the sector comparison chart. The Qs were down early this morning, and then they've rallied here. Commodities are up, and then the dollar is relatively flat. It was down earlier. It rallied throughout the day along with gold. International stocks outpacing U.S. equities, including the Qs and the S&P 500. High yield is outperforming treasuries, as treasuries are really down lower. So that's quite the significant run. Let me show you what it looks like on the chart here. So let's go to this chart and pull up TLT, and you can see the big drop. I mean, that's a big drop in 2 days after hitting that point of control, kind of not able to get above it. MACD is down, stochastic's down. Big volume the past 2 days on TLT, breaking the 50-day moving average. This is what the 10-year yield looks like. So we'll pull this up here and go to TNX. There we go. The 10-year yield, you can see it's jumped up big time, getting up into bullish levels. The short-term sentiment's up to bullish levels. The intermediate line's now rising, not quite above market sentiment line yet, but rising. You have a green line. We jumped so much that we jumped from a red line to a green line without a yellow line in between. Obviously, a light green shading. We'll see how far along that goes. But that's a big change. We haven't had that big of a drop. If I were to go here, let's go back to rate of change here, and we'll take a look at the last 2 days for TLT. Remember, it was about a 3-4% drop here on TLT. Let's go TLT here, and you can see, yeah, we haven't had this big of a drop in 2 days on bonds since back over here, after we had kind of a fake out rally and then dropped down, boom, boom, over 4% in 2 days, and then bonds continued their decline, failing to bounce and continued their decline there. And over here, we had a 2-day decline that continued. That was in the midst of a bearish move and continued it a little bit lower. So, we had been pretty bullish, but a big breakdown here would suggest that things may be changing, like sentiment may be changing in regards to long-term bonds, or we had been kind of relatively bullish here. Still in a death cross environment, but we had been relatively bullish for however many weeks there. Transition candle last week with the red arrow, big time bearish candle this week, and a big bearish move to start off the week here. And you can see the size of the candle, pretty bearish. Again, we had this size before, but we were already bearish by the time we got it, and now here we are bearish again, but now just starting. So big bearish move. Not such a big bearish move in the dollar, as you can see, or bullish move. Excuse me. We are still trending higher. We are still above the 17-day moving average. MACD is still above its moving average, so the histogram is falling. And the other big move was commodities, as they've jumped up above their 200-day moving average now. MACD and stochastics are up. Let's take a look at crude oil in particular. And you can see the breakout move it had, 2.25% move higher. 8 and 17-day really moving up higher there, making its way towards the top end above 80. That's quite the start to the month for crude oil. We've really been doing it's been doing pretty well the past couple of months. Kind of, had this fake out breakdown move here in early June, and we've rebounded pretty rapidly. And now the 8 and 17 are above the 30 and above that 200, and we are trending to the upside. That's the three-headed monster, right? Rising commodity prices, rising dollar here, and then of course the rising yield, which you won't see here, but the rising yield that has really taken off up to the upside. You'll see that on this chart. The rising yield, right? That's a big breakout move on yields, and you can see if I look at the average values, the lines for the average values, you can see breaking back above the 50-day. MACD is positive, stochastics working its way to the top half of the chart. That's a big change. We haven't had that big of a change, and a change in trend to go along with that big change. I mean, really, even the last 4 days, you've had a big move in the yield, pretty significant move in the yield there to really kind of change directions. We were sitting at 4.23%, and now we're at 4.47. Of course, it's going to have its impact on rates and rate hike expectations, or at least they kind of go hand in hand. Those rate hike expectations here will bring this up. And again, it's at September. The July meeting is not a concern. The September meeting is kind of our next live meeting. You still have, despite today's rise in yields, you still have about a 1 in 3 chance of a rate cut. Of a 2 in 3 chance of a rate cut in September. You can see the 3-month didn't really rally up very much at all. It was the 10-year that had the biggest gain here today. You can see up to almost 13 basis points. So when you look at the yield spreads, actually these two will probably be the best ways to see them because those others don't update as rapidly. I mean, that's a big change in the yield spread, up to 30 basis points here. The 10 to 3-month yield spread jumped up above the 100 basis point mark for the first time in a while. We're at 97. Now we're at 89 basis points. So that's a big change in the yield spreads. Remember, the more these spreads normalize, the more likely we are to get that first cut. So, but that's, when these spreads normalize, it's not been very bullish for equities. Traditionally, it's not been very bullish for equities. So you can see that, and it had its impact on today. It had its impact on the Russell 2000 more than the Qs. The Qs had been kind of slowing down their relative gains relative to IWM, but then you see today, IWM right here, as a kind of nice little rebound after a big drop on Friday, a big rebound today, back up above the 8-day moving average. Obviously still above the 17, even though the MACD is below its moving average, so convergence. And you see a big drop there in the ADX. The RSI is dropping pretty rapidly, though we did jump back above 60 here. So we are still showing the skew is still down below its average. That tends to be bearish. The breadth is not looking too bad. The new highs and new lows is negative, got to negative 100. But again, we haven't really broken out yet to the downside there. The number of stocks above the 50-day moving average did drop pretty sharply today. So it had been hovering around 250, a little bit below 250, dropped down to 209. So I haven't broken 200 yet, which is when things get bearish. But again, we're as bullish as we are to be that close to 200 is and with the average down so low, it's just a sign that that we're not really getting the good breadth that we normally like to see when we're bullish, right? The McClellan oscillator still at negative levels after being briefly positive for the first day on Friday, and really close to being positive back over there on the 24th. We did not. That would be last Monday. Back to negative levels, so we're almost below 100 now, and working our way towards minus 100 or to negative levels. And again, remember, we typically start an intermediate pullback when we cross 500 to the downside. So we'd be crossing 500 and 0. Now over here, you can see again, by the time we crossed 500, we were coming off those highs. By the time we crossed 0, we were in the midst of an intermediate decline. Same thing over here. Cross 500, we were off the highs. By the time we crossed 0, we were in the midst of an intermediate decline. Here, we crossed 500, we're still going up. We're about to cross 0, we're still going up. Like I said, at right now, like we're in convergence mode, which means we're still going up. We might not be going up with the momentum, but we're still going up there. You look at you can see here the sector comparison chart, and you look at XLK just continues to dominate. And there's that XLU I was talking about before, but this continues to dominate. When you look at the last 2 days here, so let's go to June on Friday. So these are the 2 days that bonds really dropped sharply and yields jumped up. Well, look, you can see what the utilities really getting hammered. Real estate obviously also gets beat up a little bit, but utilities, those are your two interest rate sensitive areas, big time hammered. Industrials, materials also struggling. Here, let's just go to like a 5-minute chart so you can see a little bit better. 10-minute chart. Materials and energy still, industrials, still struggling. XLY and XLC struggling, even though XLK is doing well. Financial is doing well, as we saw with JP Morgan. Of course, energy typically does well when the markets are when the markets are struggling, right? Energy tends to outperform. So here's the relative rotation graph. XLY right now is the only chart in the leading. Everything is moving up, so everything is gaining relative strength relative to SPY. XLK is starting to roll over, so you can see over the past 5 days or so. If I were to go back, if you like the last 5 days in particular, so we'll go back to the 25th, starting out. So these are the last 5 trading sessions. XLK, XLY doing pretty well still, and all these other areas struggling. Going back even further than that, you can go back to the last 20 days. So this would be 1, 2, 3, 4. So here's the last 4 weeks, and you can see XLK is just dominating. XLY, XLC doing well too, and utilities struggling to the downside. Not surprising, safety trade, but also the interest rate sensitivity, material struggling, industrial struggling. Those are your typical economic growth sensitive areas, right? The economy expands with materials and industrials and financials, kind of leading the market. You finance expansion and you grow through manufacturing, and so the fact that they're not doing so well, and this is just an XLK world, kind of goes to show what's really driving a lot of this price action right now, and it remains in this XLK area, even though it's starting to weaken, right? And that's going to ultimately show some weakness in the markets themselves. Here's XLK. Let's go to XLE here. There's XLK. Whoops. Try this again. XLK. Right, so the relative strength and momentum really dropping sharply here, and when we've had this relative strength in the past, like we saw that earlier this year, at the end of last year, we'll see how that plays out, because this right now, the Qs is strong, that the ratio here of the Qs IWM is strongly positively correlated with the markets. So a drop below the 17-day moving average and a drop in these oscillators, and underperformance in the Qs most likely will lead to more volatility in the markets themselves. All right, for our trade idea of the day, I wanted to take a look at Okta. We've traded this quite a bit. It's been in the bearish move. We got a bear tag here today, or Friday. Followed up with a pretty decent move here today, closing at the highs. The intermediate line crossing above the market sentiment line today. Still not out of bearish territory yet, but strong near-term run makes you think there's a good chance that we can make that run out of there. The weekly chart also looks pretty strong. Getting a green arrow last week on the transition candle, and then turning into a good bullish candle this week on the Hakinashi, closing above the 10-week moving average there this week. So that's a good strong move. Obviously, you have 3 green arrows. You had a big jump in volume on Friday, and then you followed through. You broke above the 30 and the 50-day moving averages, broke back out of the value area, held this volume node, the 200-day moving average, for support. MACD and stochastics are rising up. That's all good signs. Looking at some of the other oscillators, when you look at the DMI, you can see that you're above 25 on the positive, you're below 20 on the negative. That's a good reversal sign for the stock. If you look at its RSI and CCI, the CCI did make it up easily above 150 on Friday, got up to above 200, and we did barely close above 60, barely. We weren't above 60 during the Market Outlook Live when I put the trade on today, right before the market closed. But since then, it's continued to move higher, and now it is above 60. So that's a good sign as well. Looking at the Ichimoku cloud, you are still below the cloud. You are still have a negative rate of change, but you had a bearish trend that's now gone. You are not only above the green line, but now you're above the blue line. So there's some signs here that things are changing directions, that sentiment is changing. When you look at the Bollinger Bands and the Keltner channels, we are right up against the upper band. The bandwidth got really, really low. We are right up against the upper band. We are right up against that upper Keltner channel, and looking like things are changing. You can see the sentiment now has turned from bearish, pretty strongly bearish, or momentum, to now being slightly bullish, right? So changing direction. So you'd expect we'll get, because you typically get your change in direction during the red dots, so then you'll expect to get some green dots, especially if we were to break out above the band in the upper Keltner channel in the next day or two. So what I decided to do with this trade was to say, okay, well, let's take a look at its options chain. We'll sell that mid-30s delta, buy the 97.5 in this case. So there's the trade there, and you can see since we got into it during Market Outlook Live, that's the move the stock has already made. So we already got a pretty decent start. Maximum gain is twice what my normal risk is for this type of directional trade. And I've got a lot of wiggle room here. So as long as my maximum gain is inside of 1 standard deviation, which is what the shaded area is, we've got some room to work with, and we like that. So there's today's trade. It's the trade for today. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow me and like us on Twitter and Facebook, and follow us there as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.